you have stocks at historic levels that we have never seen before at this point. The valuations are beyond belief. And that is a concern as well. There's so much money in the system, so much money on the sidelines that still is trying to get in the market and willing to pay anything to get in the market. And then you have Warren Buffett, who has more money on the sidelines than he's ever had before at $325 billion just sitting in cash. And that also tells me something. Like a lot of people, joke about it and say, especially in bull markets, like, oh, he's like old school. The guy is smart. I mean, there's a reason why he's made the life he has. And if he's sitting on the sidelines in cash, I take note.
You're watching Capital Cosm. My name is Danny, and today's guest is Gareth Soloway. Gareth, thank you for coming back on.
It's always a pleasure. Thanks for having me.
For sure. Let's just go ahead and dive right in, Gareth. What is occupying your headspace right now? What is top of radar for you?
Well, so you got to look to the election results. The markets have had a huge move up. Crypto's had a huge move up. Gold's actually started to pull back, which is interesting in and of itself. I think there's money rotation again. We saw this early in the year with Bitcoin and gold, how, Bitcoin was ripping early in the year up into March when it made its all-time high. And then we saw this kind of pullback in Bitcoin where gold then started to take off. So interesting little kind of inverse relationship there with those two. But to be honest, the biggest thing to me is that the markets continue to see valuation soar. And it just makes me nervous, frankly. I mean, just as an investor who's seen major bubbles burst, as we just keep going higher, you have to wonder when it all stops.
Yeah. Well, let's take it from the top. What are you seeing out there as it relates to the broad market? The broad market spiked right after the election. Mm-hmm. We're now about a week removed from the election. How do you see things panning out?
So I would expect we're very close to a major target. And we can take a look at the S&P 500 here. But basically what we're looking at is you can see the big move from the elections to the upside on the S&P 500. We pierced the even number of 6,000. And for the last couple of months, I've had this upside target of 6,000 to 6,100 on the S&P. And I'll show you a couple things about this. So one, we take a trend line from the October 2023 lows, and we drag it through these levels here. And what we can see is that you go through these lows here, and then through these highs, high and high and high. And we just kissed that level again, right? And then we take this underbelly trend line right here. We drag it through these levels right through here, lows, and then high there. And these two intersect. And so as a technician, that to me tells me probability once we hit that level, which we did on Friday and on Monday, we now have a probability of a pullback. The last thing I want to show you, and this is the coolest one of all, is if we flip to our logarithmic chart on the S&P 500 and we go to our monthly, we're going to go all the way back to the pre-Great Depression. So we're going to go back to 1929 on the S&P 500. We take that high and we connect it through the last time we had a major bubble, which was in 2000, the dot-com bubble, and just extend that line out. And what we see that price is virtually right into that. I'm trying to make it as exact as possible. Now, the reason why this is important is that you had the roaring 20s and you had crazy margin and lending, and it created a bubble in the roaring 20s, which then collapsed in the Great Depression. And then arguably the next big bubble in the stock market was the dot-com bubble. And that marks the high here. And so part of me says, okay, well, if this marks major bubble highs, and we saw that in the 29 crash and Great Depression, what could we potentially be seeing here? Is this a bubble and will it deflate?
And you say the probabilities are in the favor of a deflation in this case.
Well, or a down move in the market. I don't actually buy into the deflation of the dollar and inflation, but I do think that this tells us overall that the stock market is likely setting up for some sort of dip. Now, how big of a dip? Is it going to be a depression dip? Probably not. Is it going to be a la 2000, which is the dot-com collapse, which saw about a 40% drop in the S&P? I do think that is very, very possible. And I think, again, we're seeing the groundwork being laid. The Fed is lowering rates. You have a new new president who, is likely going to put tariffs on China across the board and maybe other countries, that can be inflationary. And then you also have other scenarios about, maybe getting or taking, deporting a lot of the workforce that kind of works for minimal wages, which then means you have to pay Americans more to do those jobs, which is also inflationary. So my biggest fear is the stagflation fear, right? Which is slower growth, but inflation doesn't go down anymore. In fact, it could start to go up. And I think that's my big concern here.
Now, when you look at the Dow or the NASDAQ, do you see a similar story? People often say that the Dow is the home where foreign capital comes to lay rest in the United States. Right?
Yeah. And believe it or not, we have the exact same formations going back long periods of time on the Dow. The NASDAQ is much the same. In fact, we can bring up the NASDAQ chart here. Just let me bring it up here and we'll take a look. But the NASDAQ itself is also into some major levels here. So here's your NASDAQ. And you can see what I did here is this is already marked out on the charts where we have the .com high. So you have a trend line starting there to the 2021 high, to this little high here, which was before that August swoon. And then there we're hitting it again. And so you have to wonder again, is that telling us that we're due for a drop? Now, as of now, we have the bear market low here from 2022, the COVID low here, and the financial crisis low. And look at how those all line up in a trend line. It's remarkable, like seriously remarkable. But in the very least, probability now favors a dip back down to this level, which would be around the 15,000 level, which percentage-wise, let's do a quick draw on that just to find out what that percentage-wise would be. That would be about a 25% decline. So I think that's your base case, is that you're going to get some sort of 25% decline in the NASDAQ from these current highs.
Yeah, and that would take you back to the early days of 2024. So
that's right. Which isn't that crazy? The early days of 2024. I mean, it's not, in the scheme of time, it's not that long ago.
Yeah. Well, what about gold? You mentioned the subdued gold price we've seen lately. What do you make of the current gold movement?
Yeah, so gold's fascinating here, folks. Gold, number one, and again, for some reason, my charts aren't wanting to pop up right now. That's okay. We'll go back to them as soon as they're working again. But ultimately, gold ran up and amazingly pushed near 2,800. We've now seen it correct back towards 2,600. There shouldn't be much more downside. And again, I think you have the risk on trade right now. Everyone's jumping into crypto. Everyone's going into high risk tech stocks and small caps and mid caps. All of those things work against the idea that, gold is where you want to be. But ultimately, the end game stays the same, which is the U.S. deficit is likely going a lot higher. Countries eventually will demand more interest on our debt. We're already seeing interest rates over the last couple of months going higher and higher because of that expectation. And then ultimately, they're going to have to print their way out of it, right? So the dollar declines eventually, and we see gold eventually going, or I should say the dollar dropping and gold continuing to go higher. So I do have my charts back here, so let's jump right into it. If we go to the daily chart, so this really shows you why gold is pulling back. Going back to March of this year, which is, by the way, in March is when Bitcoin topped. Look at how that was the beginning of the bull run in gold. All right. So now you see Bitcoin bottomed, or the bull run in Bitcoin just started a couple of weeks ago. And that was the top in gold here. So we can also see here that you have a trend line. Let me bring up this and go back to regular charts, is that high pivot and high pivot align with the low pivots right here. That gave us a technical reason why gold should sell off. But that also means that gold should find major support around this 25.50 level. So there's not a lot of downside left. Now, listen, in all fairness, could gold break lower here? Yes. But you have to assume at least this will be some sort of support. And again, if you ask me where gold is next year, eventually I think it's at 3,000. I do think 2025, you see 3,000 an ounce at least.
Are we a little overstretched on the sell side? Have we oversold?
So you're getting to that point. Yeah, you are getting to that point. But again, if you look at the scheme of the bull run starting in, again, February or March, and we just do a Fibonacci retrace of that move, we're not even at the 382 yet. So I would say short term, yes. But don't be overly surprised if they try to flush out more weak hands. And that's one thing that the market, and I've learned this the hard way many times in my early years, is that, in general, the market wants to push the market higher, in this case, gold, to get those few people on the sidelines that weren't in gold. They want them to be like, oh, okay, fine, I'll buy gold. And then as soon as they do that, it reverses, right? It's the old FOMO in trade where it just, people are getting in at the highs. On the other side, the markets want to flush those people out, the weak hands out, as they say. And so they want to bring it down. So they may bring it down a little bit lower than that lower area of that channel, ultimately to kind of get those weak hands out. And then I think they take it back up and make new all-time highs.
Are we seeing a similar story with silver?
Yeah, silver's a little trickier. And again, the biggest thing on silver here, if we take a look at the charts, is that you basically have this scenario where silver is an industrial metal. And this is interesting because, number one, we haven't seen new all-time highs on silver. We're way far away from that. So you know that there's a different angle there than the safety trade of gold and why gold's just been going higher and higher until this recent correction. But you've still seen silver trading down here. And we've just broken another short-term minor support. I think silver comes down to about the 29 to 28 level here. And that's where you'll see that next major support level where you start to get another leg up. So I actually think that we're going to see, and again, this is the economic side of things, is that I'm expecting a economy here in the US that is going to show more and more weak signs, to the point where the Fed is going to want to cut more and more, and they will cut. But I do fear that on the other side, inflation is going to be bottoming out here around 2.5% and start turning back up into the low to mid threes. And that is going to create that potential for that stagflation. And also that potential where the Fed is going to have a really hard time cutting rates enough to stimulate us out of a recession, even if it's a minor recession, because of that inflation bug not going back in the box.
Are there any signs that you can point to, whether it be a chart or a data point that would signal this stagflation forecast?
Yeah, so we can look at the 10-year yield. Let's look at the 10-year yield because I think it's really fascinating to see what this is showing us. So the first thing we have here is a 10-year yield that is essentially, you can see right here, you had this wedge pattern, right? This line here and this line, it was smushing the yields. We broke down, we retraced, right? So we've had this big move up, but look at where we currently are. This is major resistance. So in this type of chart setup, probability favors a move back down and actually making new lows below 3.6% down here. The problem is you have the next huge level of support at 3.2 to 3.25. And that should be humongous technical support, meaning that you wouldn't expect yields, at least for the next year or so, to get below this level, maybe even 2 years out. In addition, you look at some of the numbers coming in about, the debts of the US and how interest is now the biggest expenditure. And that's only going to get worse. And again, the tricky thing here, and this is the real conundrum that the government is going to face, is that they need rates to go lower, because otherwise, how do they pay all this debt, right? How do they pay the service on the debt? And if you have that uptick in inflation, it's going to make it that the rest of the world will demand higher interest rates. And one thing I love to point out to people is that think about what the Fed has done recently. About 2 months ago, they cut 50 basis points. Just in the last week, they cut 25. So they cut 75 basis points. And what did yields do? Yields went vertical and rallied up. And what that tells us should scare all of us, to the point of, it says that the Fed does not have absolute control of rates. And ultimately, what has control? The market, right? So if you need other countries to buy our debt or other players to buy our debt, and they refuse, what is the Fed going to just buy all the US debt? Well, again, that's insolvency in the making. And again, that's not a good thing. So you have to allow for interest rates to go up to the point where it says, okay, this country here will now take on our debt because we're going to pay them, 5% or 7% or whatever it may be.
Hey guys, quick pause. I won't take too much of your time, but if you're looking to add into your gold and silver stack, please consider Miles Franklin. More specifically, email them, info@milesfranklin.com, and tell them that Capital Cosmos sent you in the subject line to unlock special pricing that you won't find on the website. In the unlikely event that you don't like the prices, you could always not buy. There's no commitment necessary, but I do recommend Miles Franklin for a number of reasons. The customer support is top-notch, the prices are great, and I know the people there. Great people all around. So with all that said, let's get back to the video. Thanks, guys. Don't these higher yields, though, have a downward effect on stocks?
Yes, in the and this is the tricky thing about it is that if yields are going higher because the economy is strong, which I think is what we've been seeing since that Fed 50 basis point rate cut. I think, and I was in the same camp, is that when the Fed cut 50 basis points, I said, I don't get why they're cutting 50 basis points. The economy seems pretty strong. I must be missing something. There must be something they're seeing that is hugely negative for the economy. And then we got data point after data point after data point that was strong. And so it's like, wait a minute. Okay, so the economy is strong. So rates went up because they were anticipating less future rate cuts by the Fed because of a stronger economy. Now, the kicker is this. If the economy starts to slip and go downhill, but then our debt just escalates because remember, we generally as a country, you stimulate by spending money and racking up debt during recessions. So if rates go up because it's a weak economy, but we're just jacking up the debt, then that's where it's a negative.
Yeah. And you mentioned stagflation. Does that imply higher commodity prices?
I think it does. I think in general, it's going to be a combination. So you'll have certain things where, like a copper, right? Copper, nickel, these things may struggle a little bit because of the weaker global economy. In fact, we've seen nickel come way off of its highs. Even copper's down hugely on the charts. Those are coming down because China's weak and the rest of the world is relatively weak, even though the U.S. is strong. So if the U.S. slips into recession, plus the rest of the world stays that way, then those commodities in the short term will come down. But eventually, inflation is inflation. It'll take all of those commodities back up down the line.
Is there anything that you're seeing in the commodities index that can signal that?
Yeah, so let's take a quick look at the copper chart. I think the copper chart is a great one to take a look at here. So if we take a look at copper, we can see that again early this year in 2024 in May, we had copper up to $5. I mean, an incredible run. We're now all the way back down, getting near towards the 52-week lows down here. And you can see it's breaking down again today. And that's the tricky thing. When you look at something like copper or nickel or even silver, and silver isn't as beaten up as some of these other ones, but what it is telling you is that these are industrial metals that are used in projects, right? In building. And we're seeing again the weakness here, which tells us clearly that there is an issue in the global economy. And we know China, right? China keeps trying to stimulate and they keep coming up short. It's not working as of now. And the question is there anything that they can do? I mean, how big of a stimulus package do they have to go to stimulate enough to get copper to move back up? But I think that's exactly what these metals are telling us, is that the economy globally is weak, but also commodity investors, and even with oil, it's telling us that the U.S. is likely headed towards recession still.
If not for the fact that we may already be in one, right?
That's right. That's right. And I think it's important to recognize that. And here's the chart of oil, and you can see how oil is hovering on this longer term support going back to 2021. But you're right. I say 50% of the country's in a recession. And I say that because those are the 50% that don't have investments in the stock market, right? If you're invested in the stock market, the wealth effect is keeping you immune, I would say, to what's happened with inflation. Your portfolios are going up pretty fast, up 25% this year or so. And so you can offset the rise in prices and you're still spending like a consumer that is not in a recession. Then you have people on the other side, which we're even hearing from McDonald's, that people are even shying away from going to eat at fast food restaurants because they can't even afford it. TGI Fridays just filed for bankruptcy. We're here, Boston Market, Red Lobster. And these are places where it's not really like high-end food, but it's just the cost has gone up and people can't afford to keep up with these costs. They're going back to the good old-fashioned grocery store.
So how do you reconcile these high Bitcoin prices and crypto prices that we've been seeing then?
Yeah, so I think at least, so if we go to Bitcoin, I mean, Bitcoin, amazing move, remarkable move, getting a small pullback today on the daily chart. But I think for me, this is part of the Trump trade. That's a big portion of it. So we know Trump wooed the crypto markets and the crypto investors. RFK has always been a huge proponent of crypto, and he's now likely in the administration with with Trump. And so it's really unleashed the animal spirits, as you would say, for the crypto markets. Now, with altcoins, I mean, that explains Bitcoin. The altcoins, I think the deregulation or lack of regulation is key, getting rid of Gary Gensler. So these are all things that have really awakened investors. That plus just the risk on atmosphere. I mean, what else is left to run? We've seen mid caps and small caps and large caps all start to run now. Crypto is kind of that last leg here. But I will say this is that Bitcoin and altcoins are still risk assets. If the stock market has a big correction, they'll likely turn back down.
So you've got a resistance line there. Is that your target level, you would say?
Yes. And we missed it by a hair overnight here. I want to show you this. This is a great line. So if you remember in 2021 bull market when we had the first high at 65,000, we then corrected to 30, then we went up to 69. If you connect those two highs perfectly, the line extends right there, which makes sense why that would be resistance. It's a great trend line, and we kissed it in the overnight. We didn't officially tag it unless my line's off by a fraction. But yep, that is resistance.
Interesting. So you don't see much runway left for Bitcoin, or am I misinterpreting?
So I think the key is this: is as a technician, what I would expect is I would expect a pullback here on crypto, taking you back to the former breakout level. What was the former breakout level? The 74,000 level right here. So you can see we hit here, we consolidated for like 6 months. Basically, we broke out. There's a tendency to break out, run up, then you have a retrace, and then once we get that retrace, we have to watch, and we'll have to see if this breaks. That would be really, really bad. But you would anticipate that we could potentially get another leg up in crypto, assuming that line doesn't break.
And that leg up, I see that that pointer pointed beyond the resistance level.
Yep.
Are you anticipating a break of that resistance level at some point?
I would. I mean, I think as long as we don't get back below 74,000 and start trading below there, that this is you have to play this as a bullish breakout with a retrace and buy the retrace, and then you likely have another leg up. And again, whether that's the U.S. debt and Bitcoin being an alternative, whether it's instability in the U.S., in terms of global geopolitical issues, there's so many different things that could play in. But for me as a technician, it's all about the levels. So this breakout is a bullish breakout. I do think we retrace. So that's just standard. Most charts do that. They like to retrace to what I call the scene of the crime where it broke out. And then you have to believe that the next leg will go even higher and take out that line. It may not. I mean, there's always that chance, but on a probability basis, you would favor that.
What's your highest probability target in this case? I'm not holding you to, but if you were to bet $1, where would you put the target?
So for me, what I would do is, and this is where it gets really hard because crypto is such a vertical chart over history. What I would do is I'd flip to the logarithmic chart, which gives us a little bit more smoothing of the crazy moves historically. And what I do is I would basically take these lines here and I'd start to drag them out, right? So you take the high from 2017, take it through the two highs over here in 2021, and you look at that level there. I mean, that would be the most bullish case out there. That would be like 175,000. Again, that's a little ridiculous in my head right now, but I'm just going off of this trend line here that could kind of note that. The other thing you can also do, you could potentially take a low here from 2015 and then bring it through here. There's a little bit of a lower target around 115 to 120. But either way, again, you can see how that low, then this low here, which is the 2020 COVID low. And then even right here, notice how price just hugs that line and it connects through here. And that comes up to about 115. So I would say 115 would be your first target to the upside. And then after that, if it continues, 175 could be that next level. Again, that sounds really bullish. So I just want to preempt that with saying again that these are like the most bullish scenarios ever. It doesn't necessarily mean that's what I think is going to happen. But if you just say, hey, listen, what's your biggest upside move potential? Those would be your two upside moves.
Yeah, a key indicator about this stuff is that when we head towards the latter stages of a Bitcoin bull market, you'll start to see the altcoins start to move in tandem as well. Have they started moving or not?
They really have. I mean, it's been some incredible. Now, listen, historically, they're still beaten down. But I mean, like this move on Cardano was incredible. Went from basically 32 cents all the way up to 68 cents in a matter of basically 7 trading days. So even though if you zoom out on Cardano, it's still way off of its 2021 highs, it's still a monster move here to the upside into resistance. So a lot of these things, even Ethereum, which you could argue is kind of like an old school coin now, that even had a huge move up. Look at that move on the chart, but look at where it ran into, right into a parallel channel, low, this low here, and right there, and now getting a pullback. But the altcoins have definitely started to move quite a bit.
Interesting. So wouldn't that imply that we're at the latter stages of this bull market if they've already moved?
That's correct. So now listen, we don't know how high. I mean, maybe this is just the first leg of an altcoin bull market. But what I would say is that these runs have been so massive that it certainly insinuates that Bitcoin is likely going to pull back off that level. So if we go back here, bear with me as I get rid of those old trend lines we were just looking at. We just talked about how potentially we are basically kissing a high here on Bitcoin right at this connector from 2021's highs. And that would insinuate if Bitcoin pulls back, then the alts at least have a pullback. Then we have to see what Bitcoin does. Does Bitcoin break below 74,000 or does it hold? In which case, maybe you get the second leg of the bull market in altcoins.
I see. I guess the not the correlate, but the corresponding trade to a gold trade would be the gold miners, right? I want to shift back to the physical space really quick. How did the gold miners look? How did the silver miners look given the recent dip in both precious metals?
Yeah, so you see here the gold miners have really taken a hit here to the downside. In fact, I think percentage wise, this has to be close to 20%. Yeah, about 19% drop on the GDX here. Now, the GDX is actually going to start to get into some solid support down in this lower range. So for me, for instance, I'm starting to eye this former pivot right here as maybe a little bit of an accumulation zone. In fact, we're kind of into that level today. That's a lot of technical support. There's also a secondary trend line right here where if we connect these three lows, you're kind of right into that. So I would actually, just as a shorter term trade, I actually think the GDX looks good for a bounce here. The question is, again, does gold stop going down and start going back up? If Bitcoin does pull back to 74, you'd assume gold would bounce just based on the inverse relationship between those. But I mean, this has been a big move down. One of the issues with the miners is that Newmont Mining reported these earnings, right? And you can see the massive drop on Newmont, and their costs were so much higher than Wall Street had anticipated. And that's a concern for the miners, is they need to keep that cost low so they can really make a lot of money as gold is at these crazy levels or at these higher levels. So again, just something to keep in mind. But this is a big component of the GDX, and it's definitely hurt the GDX. But even this to me is into a lot of support. Newmont Mining looks really intriguing here for a technical bounce.
Should the mining stocks catch a break if the oil price continues to move on lower?
You would think so. That would be one of the components, right? I mean, you have labor, you have machinery, but you also have the energy factor. So yes, I would think that would be a positive. And just we kind of touched on this before, but I am in the camp that see the 65 level, how many times it's hit since 2021. The more you hit a trend line, the weaker it becomes. The idea is, like, think about this. If you're locked out of your house, right, and your cat's in there, your dog's in there, and the house is on fire, you're going to try to break that door down. When you ram it once, ramming the trend line of support here, it probably doesn't break down. But if you ram it 5-6 times, eventually that door breaks down and you get through. So here you've rammed the door so many times that the probabilities favor a breakdown on oil. You got to think $50 is in play next year in 2025. What's kind of crazy is there's this bigger trend line here. Let me go to my weekly so we can see. Going back to the highs of 2008 and the lows of 1999, and they merge right at $35 a barrel. Now, again, I hate to put myself on the line and say that's where I think it's going. I think let's call 50 for next year and we'll go from there. But I would just say the charts, this would be your most likely target if this line at 65 breaks. And the scary thing about that, and I say, part of it is like, oh, yay, we can fill up our gas tanks for super cheap and like, oh, this is great. But it's not so great, right? Because what does it mean? It means that where's the economy? If you have $35 a barrel oil, where is the economy at that point? And that's another warning sign.
What does that mean for stagflation, though? If you're anticipating commodity-based inflation and then oil's at $35 or $50, how do we still get commodity-based inflation in that scenario?
Yeah, and you're right about that. With oil, that would be very, very tough. So the question is does that then keep a lid? If oil goes that far, does it keep a lid on inflation? I would guess it would somewhat taper it or tamper it. It would bring it down a little bit. But I don't think, again, everything we're seeing in the system is all about printing money, stimulating, Federal Reserve lowering rates, balance sheets. As soon as we get into hardship, the Fed's balance sheet starts to rise trillions of dollars. And so I don't see that we're going to see deflation. The question is it going to be massive inflation, or is it going to be small amounts of inflation where it creeps up with oil coming down? And I would still say that in general, I still think prices will go up, maybe not as fast, though, if we see 35 oil.
Interesting. How far out? I mean, and this may, again, I'm not going to hold you to these projections, but how far out do you think that we are in this commodity cycle, in this commodity bull market cycle?
Wow. So you mean in terms of when gold could or top out potentially, or what are you
Yeah,
thinking?
gold and oil and the rest of the commodities index.
So I already think oil's topped out. I really do believe that by at some point early next year, maybe in the first 3 or 6 months, oil breaks this line. The question is, how low does it go? And does it take 3 years for it to go to 35? Does it take 5 years, or does it just take a year? Right. For gold, I think it's a whole different ballgame. I think the world has woken up to gold. We know the central banks have been buying hand over fist for the last few years. That tells you, in my opinion, everything we need to know about why we need to own gold. If the central bankers are buying it, then we should be owning some gold, and it probably is going to go higher to offset fiat currency, degradation essentially. So the question more is, so you have the industrial metals, the nickels, the zincs, the aluminums, the oil, for instance, in the energy side. Those I think can go down, but I think other rarer commodities start to become a safe haven for other countries and for people. Even something like palladium. Palladium is an industrial metal, but it's rarer than gold. And there may be an opportunity for it to hold or even go sharply higher in a period where people stop trusting the fiat currencies more and more.
Interesting. So palladium, gold, anything else that looks attractive to you moving
Yeah, I mean,
forward?
so platinum right now for me isn't quite yet ready to be in play. But if it gets low enough, I would even think about platinum as well. And again, the idea for me is not that it's an industrial metal, which it is right now. It's more that it's so much rarer than gold. And I think most people don't realize that, is that platinum and palladium are many times rarer than gold. And so it's almost saying, okay, well, where is my store of safety? Bitcoin? Okay, maybe, but it's very risky. Is platinum and palladium a place where some money can go into, like gold, and be secure? Silver, yes. The only issue with silver, it's not super rare, right? It's kind of one of the least rare metals out there, but it is the cheapest, so it attracts a lot of more smaller investors to it.
I see. Any interesting ratios you've noticed, or any interesting signals that you've noticed in your charts that that haven't been fully talked about elsewhere?
Let me think here. I don't, off the top of my head, I can't think of anything, but I will say that, again, for me, it's these trend lines. Like we talked about the S&P trend line. There's one on the NASDAQ from the dot-com era that goes through. Like those to me kind of are big wake up calls. They're to me yellow lights flashing in front of my eyes, where you have to say to yourself, what is this telling? If the last time we hit this were major cycle highs before 50% corrections in a market and major bubbles that deflated, is there a possibility that that could be what we're setting up? And then you look at historical valuations, talking about charts and stuff like this. You have stocks at historic levels that we have never seen before at this point. The valuations are beyond belief. And that is a concern as well. There's so much money in the system, so much money on the sidelines that still is trying to get in the market and willing to pay anything to get in the market. And then you have Warren Buffett, who has more money on the sidelines than he's ever had before, at $325 billion just sitting in cash. And that also tells me something. Like, a lot of people, joke about it and say, especially in bull markets, like, oh, he's like old school. The guy is smart. I mean, there's a reason why he's made the life he has. And if he's sitting on the sidelines in cash, I take note.
Interesting. And why do you think that is, though?
I think his metrics are very standardized. He has a specific ratio in terms of earnings, price to revenue. And there's almost no stocks out there that fit that criteria anymore. And so he's just sitting on the sidelines, just like he did in '07 into '08. And then I still remember vividly when he came in and basically bailed out Goldman Sachs at the lows in '08. And he got one of the sweet, like basically he got trillion or billions of dollars for free. I mean, he got preferred stock. They paid him back in full. He got dividends for the next X amount of years. I mean, it was an incredible deal. But again, people forget that stuff. I remember it. I remember vividly when it happened during that market trading action. And it was, I mean, he was sitting there with cash on the sidelines so that when the right opportunities came where he would get massive amounts of rewards, he was ready to jump on it.
I see. Well, I think we've covered pretty much everything I had in store, Gareth. Anything else you want to talk about that we didn't get to?
Yeah, I think for the most part, you start to look at scenarios where things get overinflated. And for instance, the move on Tesla, the Tesla move, love it or hate it, it's an incredible move. The stock gaining like $500 billion in the last week off the Trump trade. Obviously, Elon Musk supported him, so it's seen a massive, massive move up. But these are things where the valuation stops making sense. And you have to start to take note of that. And so, essentially it's the fear and greed, right? When greed gets to levels where people will pay anything to be in a stock, you want to just be aware of that. And oftentimes that's the end, like you were talking, even with the altcoins making crazy moves, that can be a note of the end of a cycle versus the beginning. So just be aware. I would say just constantly think logically versus emotionally. That's how the best investors do it.
What's the signpost or two that investors should be aware of or have in the back of their heads?
Yeah, I think for the most part, it's the vertical nature. Like, you look at an S&P chart, and in fact, we'll look at the S&P one more time here because I do think this is an important thing to recognize. Is that if we look at the S&P, and let's just go to our monthly chart. So this was the vertical move leading into the .com era. This was the vertical move leading into the real estate crisis and the financial crisis. This was the vertical move leading into the 2022 pullback. And look at the vertical, like this is the steepest angle we have yet seen. And again, it's just for me, it's connecting the breadcrumbs or the dots. And it's very clear that something is amiss here. And people have to understand that the sharper you rise, the sharper you can correct. And that just has to be something that we're aware of as investors. And so just think back about that. I mean, again, if we go back to the monthly chart here, and let's just even go back again to the logarithmic, it's hard to see here. In fact, let me go to the Dow Jones Industrial Average here, because that shows a better chart going back to the Great Depression or pre-Great Depression. Let's take a look here. So if we go back here, this was the vertical move in the 20s. And to me, it looks awfully similar in the angle, almost exactly the same angle. And we know what happened following that. It does make me nervous that there is something lurking. And again, it may not be this year. It may not be next year. It might be the 100-year cycle of the Great Depression in 29 to 30. But the point being is that don't be blind. Like, the one thing that pisses me off more than anything else is when investors just ignore everything and put their head in the sand. You can still invest. Just be an investor with eyes wide open, not eyes wide shut.
Right. And if I'm calculating that right, you got like a 90% correction, not a correction, but crash.
Yeah. I mean, let's just, all of us, I really pray that doesn't happen, because to think about where we are now and what the world would be like if that happened would be atrocious. But the point being is, like, let's just say there's a 50% drop in the market, which honestly is pretty standard for most bear markets. You just want to be aware of that. Don't be buying at the all-time highs and then be surprised if it corrects 50% on you. Instead, have a stop, have some sort of exit strategy, maybe a slow dollar cost average method, something that when we get out of that, you can make money, but you just don't want to get flushed out.
Totally. Well, hey, Gareth, where can people find you?
Just come to verifiedinvesting.com. It's a website that's dedicated to probability, charts, and basically avoiding that hype, right? So social media is crazy. Legacy media is crazy. They're all pushing narratives and hype and emotion, greed, and fear. And one of the greatest things about it is that I look at charts, and that's what I do at Verified Investing. And there's so much free stuff on there. Just look at charts and make a logical decision. And that will be the best way to financial freedom.
Awesome. We'll have the links to all that down below, guys. So be sure to check it out. Thank you, Gareth, for coming on. And thank you guys for watching. If you enjoyed this content, give us a like and subscribe to the channel if you're continuing to get value out of these videos. If you agreed with what Gareth and I had to say today, right, go, Gareth, go. If you disagreed, however, let me know what you disagreed on. I do read the comments, so I'm interested to hear your takes here, guys. If there's anything you disagree with, let me know in the comments down below. And finally, check us out on Substack, capitalcosm.substack.com. You can support us there as well, and it will be an added boost to the channel too. With all that said, thank you guys for watching, and I'll catch you next episode. Bye, y'all.